Good evening, everyone. Today we'll be talking about money management. As we said previously, when it comes to being a successful trader, you need to apply the 3 M's, which is mind, which is trading psychology, money management, and method. So today we'll be covering the second important M, which is money management. Money management is absolutely crucial to your success in becoming profitable as a trader. So that's our topic for today, money management. Now we'll start off the presentation by reading to you an article which more or less summarizes what money management is all about. Now within this good article, which was titled Why It's So Difficult for Most People to Make Money in the Market, it was an article written by Dr. Van Terp in the November 1997 newsletter of the Market Technicians Association. He states that most of us grew up exposed to an educational system that brainwashes us with the idea that you have to get 94 to 95% correct to be excellent. And if you can't get at least 70% correct, you are a failure. Mistakes are severely punished in the school system by ridicule and poor grades, yet it is only through mistakes that human beings learn. Now, if you contrast that with the real world, in which a .300 hitter in baseball gets paid millions. In fact, in the everyday world, few people are close to perfect, and most of us who do well are probably right less than half the time. Indeed, people have made millions on trading systems with reliabilities around 40%. Now that last statement, which I've highlighted and made it bold, it's a very, very important point to make when it comes to trading and especially money management. Now I'll just read that again. It says here that indeed people have made millions of dollars on trading systems with reliabilities around 40%. Now, trading systems is whatever trading strategy, whatever signal you're using, whatever robot, whatever you're using to trade, that's what we refer to as trading systems. So basically, it does not matter what robot, what strategy, what indicator you're using, you are not going to get 100% success rate. 100% success rate in trading does not exist. And as you can see from this article, even a 40% success rate can make you millions. And that's the mistake most people make when they approach the markets or trading. They feel they need to find a strategy or a system or software or a signal that will give them 100% success rate. That does not exist. So you can make a lot of money with a 40% success rate. Now, the other thing to realize about this 40% success rate with trading, it means that failures and losses are inevitable, because if a 40% success rate, the flip side of that is a 60% failure rate. And again, what that tells you as a trader is that you're going to have more losing trades than successful trades. And that in itself warns you to be careful when you're trading, to be careful how much you're risking on a trade, and certainly not to be greedy. And the best way I always advise traders to remember this point or this statistic is that every time you trade, every single time you trade, you have a 40% chance of making money and a 60% chance of losing money on that trade. So basically, every time you trade, you're more likely to lose money than make money. And that in itself warns you or tells you you need to apply good money management and limit your risk for every trade you place. So that's a very, very important article and a very important statement at the end of this article about how you have to view trading and approach trading with discipline, good money management. You have to control your emotions of greed because you will soon get yourself wiped out. It's a very good article, very important article for you to remember. Now, this second article more or less complements the first article. It's an article written by Gerald Loeb, and Gerald Loeb wrote in The Battle for Investment Survival that the most important single thing I learned is that accepting losses promptly is the first key to success. So that's a very important statement that Gerald Loeb said there. He says again, I'll repeat, that the most important single thing, single being one, so the most important single thing he learned is that accepting losses, not profits, accepting losses promptly is the first key to success. So it just complements the first article that you need to accept that losses are part and parcel of trading. You have to accept them promptly and move on. Now, Loeb goes on to say that the difference between the investor who year in and year out procures for himself a final net profit and the one who is usually in the red is not entirely a question of superior selection of stocks or superior timing. Rather, it is also a case of knowing how to capitalize successes and curtail failures. Very important. So basically what trading is all about is you need to limit your losses and capitalize on your successes. So what are the money management rules? So there are rules to money management. First, you need to decide you're in the market for the long haul. So you need to decide when you want to start trading, that you're going to take it seriously, you're going to be in the market for the next 20 years or so. So you need to pace yourself. I always warn people that it's not a get-rich-quick scheme. It's a get-rich-slow scheme. So you pace yourself, take it day at a time, study the markets, limit your risks, and not go all gung-ho. So you need to decide you're in the market for the long haul and look at it as a long-term career and pace yourself. It's not a get-rich-quick scheme. Second, you need to learn as much as you can. So you need to read books on trading, on the financial markets, attend seminars to learn from experts, but be skeptical. Don't believe everything you read or everything you hear. Do your own due diligence, check it out for yourself, and make sure you understand what you're listening to. So you need to do a lot of private study and private learning. But do not get greedy and rush to trade, so learn how to trade properly before you start to trade. And again, I always advise people who want to learn how to trade to get a mentor, someone who is actively trading, to mentor them as they learn how to trade and learn how to trade properly. Also, you need to develop a method of analyzing the market. You need to develop a plan. You don't just take pot shots at the market. So you need to find a way and a method of how you can approach the market in a methodological way and have a plan that works and analyze the market well. So if you can apply these rules, that will keep you in good stead and give you a better chance of being successful in the markets. So you also have to be aware that traders are the weakest link in trading. So it's usually the trader who doesn't follow the plan, who breaks the rules, who is not disciplined, that causes them to lose money. So usually you need to work on yourself, work on your discipline, work on your psychology and your mental state, and in order to be a successful trader. Now, the goals of money management are in the following rank of priority. So the first priority in money management is long-term survival. Long-term survival is your number one goal and number one priority as a trader. You need to survive to trade the next day. Under no circumstances should you lose your entire capital in one day. So your first goal as a trader is long-term survival and surviving to trade the next day. The second goal as a money management is steady growth of your capital. So once you've mastered the first goal of long-term survival, limiting your risk and surviving to trade the next day, then the second goal is you gradually start to build up your capital. You steadily grow your capital over time. Again, like I say, it's not a get-rich-quick scheme. So you have steady growth of your capital. That's the third priority. And the third is high profits. Because obviously as your capital grows and you have more money in your trading account, you can slightly increase your risk. And as you slightly increase your risk, your profits increase. So it starts in that order. So number one, long-term survival. Number two, steady growth of your capital. And then number three, high profits. The mistake most people make when they come into the markets or trading is that they go straight for high profits. So they go for the high profits first. And by going for high profits, you become greedy, you take unnecessary risks, and that leads to rapid loss of your capital, which leads to short-term survival. So you want to do it the correct way round. So remember, winners think, feel, and act differently from losers. So you might have to change your personality as a trader. You need to find a way to become more focused, more disciplined, more consistent in becoming a successful trader. Now, I'll just show you this article from the Financial Times, and I'm sure most of you might be aware of it already, when JP Morgan lost a lot of money in the market. So you can see the headlines there. Banking shares suffer as JP Morgan's $2 billion loss raises heat over risk taking. As we all know, JP Morgan is a huge investment firm. They've been around for a long time. They're one of the top investment firms in America and the world. And they've got, super smart, super intelligent Ivy League traders working for them. They have the best of people working with them. But you can see that even JP Morgan, if they don't apply good money management, as you've seen here, they went on to lose. I think the final count was about $5.something billion. So it just shows you that, the market has no respect for anyone. So if you don't apply money management to your trading, regardless of who you are, you can end up with huge losses. So you don't want to be like this. So I'm just going to show you how you can actually become a profitable trader despite a 40% success rate. Because you'll be asking yourself, how come I'll be successful with a 40% success rate? So I'm just going to show you on a spreadsheet how you can actually obtain or become profitable with a 40% success rate. So this is just a simple spreadsheet showing you money management. Now, the minimum risk to reward ratio you want to be applying, if you look at the top of the spreadsheet, you can see at the top here, at the top left, risk to reward ratio of 1 to 3. So as a trader, the minimum risk to reward ratio, and I say minimum, there's no maximum, but the minimum is a 1 to 3 risk to reward ratio. So basically, if you're risking $1 on every trade, then that means you will lose money. Anytime you lose on your trades, you will lose $1. But if your trade is profitable and the market is going your way, you want to make at least $3. So that's what the 1 to 3 risk to reward ratio means. So if you're risking $10 on every trade, that means for every trade you lose $10 if you lose on that trade. But if you make a profit on that trade, you make $30. If you're risking $20 per trade, then you're going for a $60 profit. If you're risking $40 on a trade, then you're going for a $120 profit. Yes, around $120. So that's basically what a risk to reward ratio of 1 to 3 means. So whatever you're risking, you want to make 3 times what you're risking. So like I said in the spreadsheet there, a 40% success rate is very good, which means 6 out of 10 trades will be losing trades. So I'll give you an example here, because usually when I trade, I use a stop loss of 20 pips. Again, we're talking about day trading now. This is mostly for day trading. So I use a stop loss of 20 pips, and I go for a profit limit of 60 pips, which fits the 1 to 3 risk to reward ratio. So having a 20 pip stop loss, going for 60 pips profit limit. So if you just start with the beginners here, so for the beginners, let's assume we're starting with $500 and you're risking $1 per pip. So if you have a capital of $500 and you're risking $1 per pip and you have a stop loss of 20 pips, that means that you're risking $20 for every trade, and if you have a profitable trade, you'll be going for a $60 profit. So if you look at this sequence of trades that I've got here, so I've got a sequence of 10 consecutive trades, which could be over a week or over a couple of weeks. So it's not over one day, because you do not want to overtrade. So if you look at this sequence, on the first trade, we lost out on that trade, so we lost $20 because we have a stop loss of 20 pips and we're risking $1 a pip. On the second trade, again, we lost $20. The third trade, we made a profit of $60. The fourth trade, we lost $20. The fifth trade, we made $60. The sixth trade, we lost $20. Seventh trade, we lost $20. The eighth trade, we made $60. And the ninth trade, we made $60. And the last trade, we lost $20. So you can see after 10 consecutive trades, we've had 6 losses. So 6 times 20 is 120. And only 4 profitable trades. 4 times 6 is 240. And with a net profit of $120. So you can see, despite a 60% failure rate and only a 40% success rate, we've still ended up with a net profit of $120. And that's what money management is about. So you can see, when we lost, we limited our risk. And when we made a profit, we capitalized on that and at least made 3 times what we lost. Now, if you apply the same principle, if you're going into the intermediate trader, so if you have a capital of $3,000 and above, so once you have a capital from about $3,000 and above, then what you then do is that this is a universal rule from $3,000 and above, that you only risk 2% of your capital per trade. So you only risk 2% of your capital per trade. So again, you can see the example here. The first trade, you only risk 2% of $3,000, which is $60. And then if you lose $60, you're down to $2,940. So for your second trade, you'll be risking 2% of $2,940. So you always risk 2% of what you have left in your capital before you start the trade. So it's an inbuilt system whereby as you're losing, you'll risk less, and as you're profiting, you risk more. And as you can see, again, 6 losses out of 10, total loss $350. Only 4 profitable trades out of 10. You've got $660 with a net profit of $310. And again, no matter how much money you're trading with, once you're above $3,000, it's 2% of your capital per trade. So even if you're trading with a capital of $200,000, again, it's still the same 2% of your capital per trade. So you can see 2% of $200,000 here is $4,000. So if you lose $4,000 in your first trade, you're down to $196,000. So your next trade is 2% of that, and so on and so forth. And again, you can see, despite 6 losses out of 10, total loss $24,910, and only 4 profitable trades out of 10, total $48,570, and net profit $23,660. So you can see that's how you become a profitable trader with a 40% success rate. It's by applying the minimum risk reward ratio of 1 to 3, making sure you're disciplined and you keep to that ratio. You don't risk too much when you're placing your trades. You're consistent with your plan and your method of approaching the market, analyzing the market, and this is what will make you successful as a trader. Very, very important. Okay, so this is a topic on money management. And like I said, always remember the 3 M's will always make you successful as a trader. The 3 M's again are mind, which is trading psychology, making sure you're disciplined, you have a good mindset, you can control your emotions, you don't succumb to greed and fear, and you're disciplined. The second M is money management, which we've just covered, which is absolutely crucial in your success as a trader. It's you remembering that a 40% success rate is good enough for you to be a profitable trader, knowing that losses are inevitable in trading, so you need to limit your risk. And again, as I showed you just now, the spreadsheet, you use a minimum risk to reward ratio of 1 to 3, and make sure you don't risk too much on each trade. Okay, so that's it on money management. And in the coming weeks, we'll also then be talking about trading strategies. As we lead on, I'll walk up to our live trading sessions.